Q2 2026 net income for the Hartford is $1.3 billion.
Oh,
Yeah, that is $4.68 per diluted share, which is a massive 31% increase year over year. Core earnings came in at $945 million, or $3.42 per share. Total revenues just hit $7.26 billion.
those are some heavy numbers right out of the gate.
They really are. And, for you listening, just a quick context note here. We are looking strictly at the raw SEC 10Q and the earnings released directly from the company today. We are completely bypassing Wall Street consensus estimates. We are ignoring management guidance, and we are paying zero attention to post-market stock reactions.
Man, none of the noise.
Exactly.
Yeah.
We are here to look strictly at the hard reported facts. And I got to say, the two facts jumping right off the page are a staggering 23.8% trailing 12-month net income return on equity and the authorization of a brand new $4.2 billion share repurchase program.
Which is huge.
It is. That buyback is a 27% increase from their prior authorization. Okay, let's unpack this.
Yeah, the sheer velocity of that capital return is exactly where we need to focus today. I mean, a 23.8% return on equity, that doesn't just happen by accident, especially in, the mature, highly regulated insurance sector.
Right.
So we are going to deconstruct how the Hartford actually engineered these numbers. We'll look at their segment performance, their honestly ruthless underwriting discipline, and what turned out to be a massively lucrative quarter for their alternative investment portfolio.
Okay, well, let's start with the primary engine of those headline revenues, which is the
Yeah.
property and casualty segment, or PNC.
Yep, the bread and butter.
Exactly. More specifically, we need to look at business insurance. So the filings show a 5% growth in written premiums, bringing earned premiums for that specific segment
Yeah.
up to over $3.6 billion for the quarter.
Right.
But the number that really caught my eye was the small business division.
Right.
That grew by 7%, heavily driven by double-digit new business growth. It paints a picture of a very aggressive, successful push into the small commercial market.
What's fascinating here is the underlying margins supporting that top-line growth. Because, in the insurance business, growth means absolutely nothing if you are mispricing the risk.
Yeah, you can grow yourself right into bankruptcy.
Exactly. You always have to look at the combined ratio. And the Hartford's underlying combined ratio for business insurance came in at a highly profitable 89.3.
I want to pause on that metric for a second just to make sure we're all on the same page.
Yeah.
Because understanding the combined ratio is, it's really the skeleton key to understanding this entire 10Q.
Oh, absolutely.
So a combined ratio under 100 means the company is making an underwriting profit before they even invest a single dollar of those premiums.
Right.
So an 89.3 means for every $100 they collect in small business or commercial premiums, they're paying out $89.30 in claims and operational expenses.
Yeah.
They are pocketing over 10 cents on the dollar purely from the act of insuring the risk.
And maintaining an 89.3 in today's macroeconomic environment, that requires really intense, disciplined underwriting. The 10Q actually notes that pricing increases are earning across most lines of their commercial business.
Right. So what does that look like mechanically?
Well, it means that when, say, a mid-sized manufacturing company or, a local bakery renewed their policy over the last 12 months, the Hartford pushed through a significant rate hike.
Gotcha.
Because insurance policies are annual contracts, that revenue doesn't hit the income statement all at once. It earns in day by day over the course of the year.
Oh, okay. So this stellar 89.3 margin we are seeing today is actually the delayed financial payoff of some very tough pricing conversations their underwriters had with clients, 3, 6, or 9 months ago?
Exactly. They are successfully raising prices faster than the underlying cost of claims. The loss trends are rising. They aren't just accumulating more policies, they are methodically accumulating more profitable policies.
Okay, but then we look at personal insurance, and the narrative just completely flips.
It really does.
Written premiums for personal insurance actually dropped by 7%, down to $915 million. So if commercial revenues are up and the overall business is booming, why is this specific segment shrinking? To me, it looks like they are pruning the tree to save the roots.
That is the perfect way to visualize it. They are absolutely pruning, and they are doing it very aggressively. The underlying combined ratio for personal insurance improved 1.7 points to 86.3.
Wow.
Yeah, that is a stellar number. It is actually a better margin than the commercial side we just praised.
But how are they doing that while shrinking the revenue?
The mechanism for how they achieved it is critical. They got there by deliberately shrinking their auto insurance book.
Ah,
The SEC documents note that growth was impacted by a highly competitive market and a purposeful decline in auto policies in force.
yeah, let's talk about the reality of that auto market because it has been brutal for insurers.
Truly brutal.
We've seen parts inflation, labor shortages at body shops, and I mean, modern cars are just packed with expensive sensors right behind the bumper.
Yeah, a fender bender isn't just a piece of metal anymore. It's a computer replacement.
Right. So instead of trying to fight for market share in a deteriorating environment, they're just letting the auto policies run off. They're actively choosing not to renew or, I guess, just price themselves out of unprofitable business.
Which is incredibly hard for a management team to do because Wall Street traditionally loves top-line revenue growth.
Always.
But the auto insurance market is currently defined by severe margin pressures. Instead of chasing unprofitable scale, the Hartford is prioritizing the bottom line.
Okay, so they're shrinking auto.
Yeah, while pushing aggressive pricing increases in their homeowners insurance lines, they are systematically shrinking the auto book to ensure the business they do keep on the balance sheet is highly profitable. It is a masterclass in prioritizing margin over market share.
Which makes sense. I mean, if the environment is toxic, you reduce your exposure. Now, if they are shrinking their auto revenues, they have to make up that cash flow somewhere else.
Right.
Which brings us to the second segment, employee benefits. So we are transitioning from protecting property to protecting the health of the workforce.
A completely different risk profile.
Totally.
Yeah.
But looking at the 10Q, this is where top-line growth seemed to hit a wall of bottom-line pressure. The numbers show fully insured ongoing premiums grew by a solid 5%, and sales were actually up an impressive 31%.
That's a huge sales jump.
Driven by group disability and group life sales, I think.
Yeah.
But the core earnings margin dropped from 9.2% in Q2 of last year down to 7.4% this quarter. Why the sudden disconnect?
The answer is buried right there in the disability claims data. The group disability loss ratio spiked 6.3 points to 74.8%.
Okay.
That single metric is what compressed the overall margin for the entire employee benefits segment.
Wait, a 6.3-point jump in a single year? That sounds highly significant.
It is a big move.
So is this just a cyclical blip, or is this something a retail investor should genuinely worry about? I mean, are we seeing a macro trend of workforce burnout, or maybe the long-term effects of chronic illness hitting the insurance market all at once?
This raises an important question, and it is a notable jump that really requires context.
Okay, so what's the context?
The management commentary in the 10Q attributes this spike directly to increased claim incidents across both short and long-term disability products.
In plain terms, more people filing claims.
Yes, a higher volume of workers are filing claims. Furthermore, and perhaps more importantly for the margin, they are seeing less favorable long-term disability claim recoveries.
Let's clarify that term for the listener. Claim recoveries in this context means people getting healthy, returning to the workforce, and consequently coming off the disability payroll so the claim officially closes?
Exactly. The rate at which individuals are rehabilitating and returning to work is slowing down compared to historical averages.
Ah, I see.
So you have more people entering the disability system and fewer people exiting it, which creates a compound pressure on the loss ratio.
That sounds like a recipe for a structural crisis.
Well, before anyone assumes that, we have to look at the full context of management's forward-looking statements. They explicitly stated that despite this 6.3-point spike, the loss ratio is still, and I quote from the filing, in line with long-term expectations.
Let me push back on that a bit. How can a massive spike in claims be in line with expectations? Does that just mean they modeled for this level of pain? Like, they priced the policies 3 years ago anticipating this exact level of volatility.
That is precisely how actuarial science works.
Really?
Yeah, employee benefit policies, especially long-term disability, they are not priced for a single perfect quarter.
Right.
They are priced using complex, multi-year assumptions about morbidity, which is the frequency of illness or injury, and longevity, which is how long a claimant might remain on the system.
So they build a buffer into the pricing.
Exactly. Management is signaling to the market that while claims are up year over year, perhaps due to macroeconomic stress or changing workforce dynamics, this current frequency hasn't breached the outer stress test thresholds they built into their risk models. They expect volatility and they collect premiums to cover it.
Okay, that makes sense. Let's shift focus. We've talked about the underwriting engine, but insurance companies don't just collect premiums and lock them in a vault.
Definitely not.
They invest them. And it looks like the Hartford's Treasury Department capitalized on the current macro environment in a massive way this quarter. Net investment income surged 22% to $800 million.
A huge jump.
Yeah, and here's where it gets really interesting. Look at the limited partnership, or LP, income line item. In Q2 of 2025, it was just $13 million. This quarter, it rocketed to $114 million.
That is a staggering jump, and it requires us to peel back the layers of the 10Q to understand why.
Is what's driving it.
Well, life and P&C insurers inherently hold massive conservative bond portfolios to ensure they can pay claims. But to juice their overall yield and fight inflation, they also allocate a smaller portion of their assets to alternative investments, these limited partnerships.
Right, the higher risk, higher reward stuff.
Exactly. The Hartford explicitly attributes this $114 million windfall to the sales of underlying investments within real estate joint ventures, as well as exceptionally higher returns on infrastructure and energy transition funds.
I am looking at the yield breakdown here, and it says the annualized LP yield hit an incredible 7.6%.
It's massive.
That is a massive return to drop straight to the bottom line, especially when you compare it to the annualized yield on the rest of their traditional fixed income portfolio, which, hovered around 4.7%.
If we connect this to the bigger picture, it highlights the dual engine nature of a well-run insurance company.
What do you mean by dual engine?
You have the underwriting engine, generating a combined ratio in the high 80s, creating a massive flow to free cash flow.
Right.
Then you have the investment engine, deploying that cash into private markets, real estate, and infrastructure to generate a 7.6% alternative yield. When both of those engines fire synchronously, you get that 23.8% return on equity that we highlighted at the very top of the show.
Which is an incredible setup. But that actually brings me to a really glaring accounting gap in the income statement that I need you to clarify.
Okay, what is it?
So the headline, net income, was $1.3 billion. But a few lines down, core earnings were only $945 million.
Yeah.
That is a $348 million difference.
Yeah.
For retail investors reading this release, what accounts for a gap that large between the two profit metrics?
That gap is the perfect case study for why serious investors must look at core earnings to understand an insurer's recurring operational health, rather than just cheering for the headline net income.
Right, because net income can be distorted.
Exactly. So, the Hartford entered into a definitive agreement to sell Hartford Funds, which is their mutual fund and asset management business.
Right, they were completely getting out of the asset management game.
Yes. And selling that business triggered a massive $251 million income tax benefit.
Wait, hold on. A tax benefit? How does selling a business generate a $250 million tax benefit? Usually, when you sell an asset or a business unit for a profit, the IRS steps in and takes a substantial cut. They certainly don't hand you a $250 million check. What sort of accounting magic is happening here?
It sounds like magic for sure, but it is actually a strict application of accounting rules.
Okay, break that down for me.
The 10Q explains it as the difference between the tax basis and the U.S. GAAP carrying value of Hartford Funds.
Right.
To put that in plain English, imagine you buy a piece of heavy machinery for a factory. Over time, the government lets you depreciate that machine for tax purposes at a different speed than your standard accounting books, your draft books allow.
So you end up with two different values for the exact same asset depending on who is asking.
Exactly. Over the years, the Hartford had built up a scenario where the value of the Hartford Funds business on their official accounting books was different than its value for tax purposes.
Oh, I see where this is going.
When they signed the agreement to sell the unit, it allowed them to realize what is called a deferred tax asset. Essentially, it is a massive tax credit that they can use to offset future tax liabilities.
Oh, wow.
And accounting rules dictate that once this asset is realized through the sale agreement, its value must be recognized immediately on the income statement.
So, because they are selling a discontinued operation, they get to book this massive tax credit today, which artificially inflates the net income.
It pushes the net income all the way up to that $1.3 billion mark. But, and this is the crucial part for the listener, it is a one-time, non-recurring accounting windfall.
Right. It's not repeatable.
Exactly. That $251 million has absolutely nothing to do with their ongoing ability to price commercial insurance policies or manage disability claims.
Which is why management strips that massive number out to calculate core earnings.
Right.
Core earnings give you the actual unvarnished run rate of the continuing business. If you want to know how the pure insurance operations performed this quarter, you ignore the $1.3 billion and you focus intensely on the $945 million in core earnings.
You've got it. That is the true pulse of the business.
All right, well, now that we've deeply unpacked the mechanisms, the margins, and the tax accounting, let's look at the narrative.
Okay.
What is the C-suite actually signaling to the market? And more importantly, what forward-looking risks did their lawyers force them to flag in the SEC filings?
Always look at the risk factors.
Right. So I'm looking at CEO Christopher Swift's commentary, and he focuses heavily on a disciplined approach to capital management. Then you have CFO Beth Costello pointing out the attractive new money yields supporting the fixed income portfolio.
Management is essentially taking a very structured victory lap regarding the sheer power of their balance sheet.
Yeah, they sound pretty confident.
Let's talk about the mechanics of those new money yields Costello mentioned. We are in a higher for longer interest rate environment. For a highly disciplined insurance company, that is a dream scenario. Every single day, old bonds in their portfolio that were yielding maybe 2 or 3% are maturing.
Okay, so the cash frees up.
They take that cash, plus all the new premium dollars coming in the door from their commercial growth, and they immediately reinvest it into new bonds yielding 4, 5, or 6%. The cash flow generation becomes this self-sustaining flywheel.
Which completely explains how they have the capital to comfortably authorize a $4.2 billion share buyback program running through 2028.
Exactly.
You do not commit to buying back billions of dollars of your own stock over a multi-year period unless your internal models show you are going to be drowning in free cash flow.
It is the ultimate signal of executive confidence.
Okay.
But as you mentioned, the 10Q is a legally binding document.
Right.
They are required by the SEC to lay out the specific risk factors that could derail that confidence and interrupt that cash flow flywheel.
Right, the risks. We touched on them as we hit the individual segments, but if we're building a bear case, we need to summarize them clearly.
Let's do it.
First is the ongoing margin pressure in personal auto. They are pruning the book now, as we discussed. But if loss trends, specifically the hyperinflation in the cost to repair modern vehicles and the ongoing litigation costs associated with bodily injury claims, continue to outpace their regulatory ability to raise consumer rates, that segment will remain an anchor dragging on overall returns.
Absolutely. The second major risk is the elevated disability claims incidence we explored in the employee benefits segment.
That 6.3-point jump.
Right. Even if management confidently states it is in line with long-term actuarial expectations today, a 6.3-point jump in the loss ratio in a single 12-month period is a glaring trend.
Definitely.
If those claims continue to rise, or if workers are staying on long-term disability indefinitely due to shifting macroeconomic factors or chronic health trends, those actuarial models will eventually break. If that happens, that 7.4% margin could compress to zero.
And the third risk is the inherent unavoidable volatility of relying on real estate and limited partnership investments to juice the overall yield.
Yeah, alternative assets.
Yes, they had a massive $114 million windfall this quarter. But alternative investments are notoriously illiquid and lumpy.
Very lumpy.
You cannot guarantee that you will be able to sell a commercial real estate joint venture at a massive premium every single quarter. If the commercial real estate market locks up or infrastructure valuations drop, that 7.6% LP yield could turn into a negative drag very quickly.
That is the fundamental trade-off of alternative assets. They provide high-octane returns during favorable macroeconomic conditions, but they trade stability and liquidity for that premium.
Right.
It is exactly why regulators require insurers to keep the vast majority of their assets in high-quality, boring fixed-income bonds.
Okay.
You can't pay a sudden influx of hurricane claims with a piece of a real estate joint venture.
Exactly.
You need liquid cash.
So what does this all mean for you, the investor dissecting this quarter? The Hartford is aggressively repurchasing its own shares, marking a 27% increase in their buyback authorization.
A huge bet.
They are effectively pushing billions of chips to the center of the table, betting entirely on themselves. But at the exact same time, they are purposefully shedding Hartford funds, completely exiting the mutual fund and asset management business.
It's a profound structural simplification of the entire enterprise. They're intentionally making the company less complex.
They are. Which leaves you with a really fascinating thought to mull over. By exiting the asset management business just so they can free up capital to buy back their own stock, is the Hartford signaling that being a pure play, highly disciplined property and casualty and benefits insurer is the ultimate fortress against future market volatility.
That's the real question.
Right. Perhaps the cleanest, most predictable way to generate a 24% return on equity isn't through complex fee-based mutual funds, but through the ruthless old-fashioned discipline of writing highly profitable insurance policies and letting the bond yields do the heavy lifting.
It is a back-to-basics strategy, and it certainly makes the balance sheet a lot cleaner to evaluate.
It really does. Well, thank you for joining us today as we bypass the market noise to look strictly at the mechanics and the facts. Be sure to follow the show for our daily deep dives into the earnings reports that drive the market. We will see you next time.